Francisco Blanch with us, folks. Oil, it's a big question. Boy, do I get mail on oil, and thrilled to have Francisco on with, of course, with Bank of America, Merrill Lynch. Are we going higher or lower in oil?
Well, Tom, in the short run, I think oil still has some support. We have a lot of issues on the demand side, including an electricity shortfall in China. We also have, obviously, the peak demand season throughout the summer months in Japan, which is obviously lacking a large amount of nuclear power. So in the short run, oil is going to be well supported. Now, the second half of the year, Tom, I'm getting a little bit worried because I think the macro environment is turning pretty quickly. And then there's, of course, the issue of the Middle East. So I would say, short run, we still hold up at these levels, maybe a little bit higher. Second half of the year, we should go lower on the basis of the weaker macro data.
I'm going to have a chart tomorrow, folks, on this. Let's bring up this chart. Brent 200-day moving average approaches $100 a barrel. When does the price of oil become persistently high versus a run up and then a run down? How do you gauge that? How do you measure that?
Well, I think it already has. If you look at 2010, in 2010 prices averaged about $80 a barrel for Brent, and pretty much the same for WTI, because we did not have the oversupply situation at Cushing, Oklahoma. I mean, demand last year ran at a rate of almost 3 million barrels a day, and supply ran at a rate of around 2 million plus. So we were drawing inventories, particularly in the second half of last year, and then we had Libya, which basically lifted the equilibrium oil price by around $15, $20. So that's where we stand today. I mean, I think oil prices are already persistently high, and I guess the main question here is, when does the macro outlook start to deteriorate? And I think that the most recent data suggests it might be already.
So critically for our viewers, do you suggest that a diminished or dampened demand, the so-called demand destruction, will be different this time than a more prosperous 2008?
Well, I mean, I think the demand destruction argument is definitely gonna hold up. I mean, if you look at the first 4 months of the year, all the fiscal stimulus that was passed on in December in the U.S. was wiped out by the higher oil and food prices. So clearly, that's being reflected in some of the data that we received in the month of May. I mean, I think some other emerging markets have been hiking interest rates a lot faster than we would have expected because of the very high energy prices. So again, Tom, economies have a lot of moving pieces, but I think that the macro environment is turning a little bit. Now, I don't think we're going into a big downturn, but certainly we should see slightly lower prices, what we call a mid-cycle pause or a soft patch in terms of economic growth.
We got to start a pool here. Every time somebody says soft patch, we got to have a gong or something. Francisco, when you look at copper, let's switch from oil to within your commodity reach. Copper, bring up the chart, folks. This is back 8 years or so. Up we go. What a boom. We've barely come back. What does it signal, Francisco, that we're on a lather about lower commodity prices when they barely come back from a 4 or 5 year move?
Well, Tom, you have to remember that there are some commodities that are very tight, and oil suits that bill, but also copper. There are other commodities, on the other hand, that are actually very loose from a supply-demand balance perspective, and U.S. natural gas is one of those. Remember, natural gas trading between $4.50 and $5 per MMBTU, around $27, $28 a barrel of oil equivalent. Now, copper, of course, is a very tight commodity. The supply of copper will increase only by 1%, 1.5% this year in a world economy that's trying to grow by 4 or 5%, Tom. So naturally, the price has to reflect that. It's going to be a tight market. Now, of course, if growth decelerates all of a sudden, then suddenly there's no support for that price, right? You come back to marginal cost of production.
Which is your single best buy in commodities? Which is the long or short? Which is the one that seems to be most attractive right now?
Well, we like the PGMs quite a bit, particularly platinum, palladium at this point, because we think that if the Fed is put into a corner and has to go for a third round of quantitative easing, that's going to help lift the price of platinum, palladium higher. But also under a scenario where growth recovers, we see those metals doing well on the back of increased car sales. And also I think the additional boost is that Japan has been offline in terms of car manufacturing to a large extent for the last couple of months. They will be buying more in the second half of the year. So for the second half of the year, from a buy perspective, we like those two metals.
Francisco, thank you so much. Francisco Blanch with us from Bank of America Merrill Lynch.